All right. Hi. How are you, Lakshman?
Good morning. How are you doing?
Good. Great to catch up with you. Lakshman is, it's, he inherited this from his mentor, the Economic Cycle Research Institute. Could find Lakshman on Twitter at the Business Cycle, not just at Business Cycle. So, Lakshman, you've been talking hard landing all the way through, never lost your conviction about that. What are you seeing now? When do you think there feels like we're already in a recession? When do you think they'll declare it really started?
Oh gosh. Good morning.
Good morning.
That could,
Too early
that,
for
no, that's fine. It's just I wouldn't hold your breath on declaring anything. It's just not the
okay,
nature of it's not the nature of the beast. It happens way, way after the fact.
right.
Um, in terms of the National Bureau declaring it. Um, Market participants, I think, would get there quicker, but that still can take a while. And just really quick, thank you for the intro, Dale. Let me say hi to you too. See if you
Okay,
can see
buddy.
me. There I am.
Yeah, hey, how are you,
Good
buddy?
morning. Let me say
Good.
hi. Real quick. So what we are doing, as you said, doing cycles. I'm looking at forward the risk of a cyclical turn, and I use that word very, very precisely, cyclical turn, um, in growth uh, uh, or inflation. We're looking at those as two distinct cycles for 22 economies around the world, and that's the focus of the work. And certainly that can impact the decision making process. I heard you all talking a little bit about some currency
Real estate.
prices, for
Oh,
example, but
okay. Yeah.
it could be any kind of business, all kinds of decision making. You have to make some guess as to what the risks are out there.
The big mystery we were talking about, Lakshman, was the fact that real estate markets have held up so well through this
Right.
massive, and we all know that the US, most people have 3% mortgages, but
Mhm.
there's been very little impact on price.
So far, yeah, that'll.
Yeah, so far
I mean,
there's a
the
qualifier.
the cure for high prices is high prices, right? So
Yeah,
that can still happen. There's some in the so that's our discussion is growth and inflation cycle
yeah,
turning points, 22 economies around the world. The US is the primary focus. And just to give you a little insight as to where um, a lot of the discussion is at the moment with us and our clients is it's all around rates and what's going on there, because that's going to set the tune for so much else, including real estate. And there seems to be this kind of begrudging acceptance of higher for longer, that has been playing out for a long time now, more than a year. The higher for it's
right.
that, are we there yet? Are we there yet? Are we done? And you see people have been the markets have been adjusting their
Could we
expectations.
be done for a while, getting up towards this 457 level on the 10-year, and have some type of growth scare going into the end of the year and
You
yields
know,
come
it's
down?
Yeah, well, I mean, on the actual Fed itself and what it's doing on the shorter end, I'm not sure that there's many more hikes there, right? But uh the idea that they're going to be easing anytime soon, I think has been put to rest for the time being.
Yes.
Um and the soft landing narrative, as long as that's kind of breathing and out there, is going to be pushing up those longer end yields, and then it doesn't help what's going on with the deficit and the supply issues and who wants to buy all that debt. So
Right.
that makes the long end go up. So I'd hesitate to say we've seen the high in the long end. That's unclear. I mean, if the soft landing narrative is chugging along and the supply is large
Yeah.
of debt, then you can see that go higher. But to your earlier point, or where you're pivoting from the beginning of the discussion on real estate, those typically, just typical cycles, they can lag a bit. There takes a little while for, because there's always hope that things will work out. We were talking with a client with a pretty big portfolio or exposure to, they have a lot of managers running real estate investments, some sort of stuff. And when you kind of needle down into this issue, it boils down to hoping that rates are going to go down, to kind of make it more likely that they avoid a real serious crack up in their portfolio, right? Because you can't handle these high rates in some of these business models.
Well,
And
they're not going to
you've
be
heard,
able to roll over the
yeah,
rollover of their debt from a couple of years ago. There's
that's a
going to
struggle.
be a reckoning.
Well, so hope is not a plan, right? I mean, you could hope,
Right.
but I'm not sure it's a great plan. And under the circumstances, the longer the soft landing narrative or reacceleration narrative is out there, then you've got the likelihood that the rates are going to hang in there. The economy itself is slowing. It's continuing to slow. I could throw up a quick chart, if you
Okay.
want, of the
Sure.
economy itself, and it just the coincident index. Let me see if I can grab
Do you
this.
think
There.
that we could have a weak jobs number in the next NFP that could be like something lights a fuse over people starting to think
Yeah.
about you think that could be the catalyst?
Well, I don't know the next one. I mean, that's a roll of the dice,
Yeah.
right?
Yeah.
The next number. But around, I know the lay of the land around cycle turns. They on downturns, the revisions to these big numbers tends to be to the downside. So you could have, sometimes you could have an actual fresh print that'll be surprising to the downside, but certainly in the revisions, and I think we've already seen that some of the revisions of the summer and earlier went to the downside. This indicator I'm showing you here,
Yeah.
that's the coincident index. That's the hard data. It's not a forecast. And it's the economy outside your window. And, it's
Lower
messy.
highs, lower
It goes,
lows.
it goes
Yeah.
up and down. This is the growth rate. That's
Yeah.
just about a 2% growth rate, a little higher than 2 there. And now we're down to 1.25 in August. And that is very large data on output, employment, income, and sales for the aggregate national economy.
Weak.
So, well, all I'm going to say is it's decelerating. Okay.
Okay.
And I can also tell you that the
You could be
reason
an
that,
ambassador.
yeah,
Yeah, go ahead.
this could be this. I think also that this number, this line would be going negative if jobs growth had not held up as much as it has. Now, on housing, you were talking earlier, these prices kind of hanging in there. Where's the downturn? Part of it is kind of mismatching between some supply and demand. And then on the jobs side of things, it's also, again, some supply and demand stuff at work here. So I'm going to pop up a few slides that that we've been done at Equity about the hollowing out of the jobs market. So the narrative is jobs are strong, they're tight, they're growing. This is going to support the consumer, and therefore we're not going to have a recession or something like that, right? And here, what we're finding is that, yeah, it's true, jobs growth is still positive, but there is a really big tug of war going on in the jobs market between what we would call this kind of post-COVID backwash stuff and cyclical forces. And so post-COVID backwards stuff is responsible for a hunk of labor leaving the labor force. You
Right.
could attribute it to COVID, early retirement, legal immigration stuff, where for a period of time we didn't have as many incoming, and so into the workforce. So that's a hunk of the workforce which isn't there. It's tighter supply. And separately, we've had some kind of post-COVID related stuff around very targeted spending. You had I'm not even going to the stimmy checks and all of that, which is large, but stuff in the Inflation Reduction Act or the CHIPS Act and these things, which are very targeted spending things. And we could see, for example, in non-residential construction employment, which typically would be going down here, and it was headed down, popped up a lot of factories being built all of a sudden. Not because of a huge demand, but because of a dictate that they should be built, and so that takes people. And it doesn't help that construction productivity is just abysmal. It takes almost 2 people to produce the same output as was produced in the 1990s in construction. So
Isn't
that's
there
going to
still
make it.
supply? Isn't there still supply chain issues in that part of the market too? A friend of mine was looking to buy a house to fix up, flip, and it would take him
Yeah,
3
there's
months to
some.
get an electrician to
Yeah,
come
yeah, yeah.
out and
No,
do the work.
well, that's labor supply.
Yeah,
This is
and the
labor supply
parts. And a friend in
and the parts.
solar, they can't get the parts from China to
And I
do
don't know
their
how many.
jobs.
I don't know the age demographic of everybody listening, but I'm just going to give a plug for us older guys and say that, some of the more experienced construction workers were pretty productive, and the younger ones are having to learn a bit on the job, and so it might be weighing on productivity. There's also regulation and stuff which is really weighing on productivity. But here, let me show you this chart. So this chart is a measure that we derived from some Fed work, where the Fed had done a lot of work saying, what are the best indicators of the employment stuff? And so we took that and refined it further to what are the indicators that they're looking at that are cyclically driven, related. And this is the index you see in front of you, the Cyclical Labor Conditions Index. And what you see is that this indicator pretty much gives it up. It turns down ahead of or inside of recessions. And it has done that now. You can see this type of decline is not something that we see away from recession. And you could very well be in a recession when this is happening. The level here is back to some of the spikes in front of the COVID recession.
Yeah.
But you see the level isn't a great indicator of whether it's recessionary or not. It's really the size of the move down.
Okay.
And so
direction. Yeah.
this is consistent with our more anecdotal observations, which is like, if you look at a jobs report, the discretionary sectors aren't doing well. But something like health or education, that's where there's a little bit of continued growth. Another pattern that shows us the jobs market is weakening up under our feet is temporary employment. And you see declines in the level of temporary employment, again, around harder landings, right? They're associated with harder landings. So that's about a 7% decline in the level here. And we haven't seen that kind of decline unless we're in the vicinity of a harder landing. I'm drilling down into jobs. I'm picking on jobs because that's the thing that's holding up the coincident index from being negative. Here, we look at weekly hours, and you see weekly hours weaken, or they are reduced into recession. So if you are a business manager and you're trying to navigate the economy after COVID and the recovery, and you've got the issues of the supply chain things, and you've got the issues that there are, millions of people missing from the jobs market, you are going to be very careful with your employees. You're not going to push them quite that hard. You're going to, because it's hard to replace them. And so before you fire them, you'll let go temporary workers. Before you fire anyone, you're going to
cut their
reduce
hours.
their hours. And this is happening. What's kind of interesting is that this is happening, these patterns all present themselves during the you only live once, the YOLO summer, where everybody was like, that's it, I'm sick and tired, I'm gonna go on my trip, my bucket list has been on hold, whatever. And kind of, it was damn the torpedoes in the summer, and people went out and did whatever they did, and this is still happening. So the end result, if we look at jobs growth, this is a good preview going into the jobs report. This is year over year headline jobs growth is down to 2%, and year over year household jobs growth is down to, I don't know, it's like 1.6 or 7 here, something like that. This has been declining for a long time, going on a couple of years now, and in this case, I would just say the trend is not your friend. It's if this keeps going, if there's no re-acceleration in front of us, then this is likely to go negative. And in a way, that kind of seems to be from a at least if we stick with the Fed for the moment, from the policymaker, from the Fed side of view, that's kind of what they want or need.
Yeah, that's what they've been trying to accomplish.
More demand destruction. It would be great to have immaculate disinflation, but that might be a pipe dream. And so I think they would, and I've said this before when we've talked, if they had to choose between a hard landing and mission accomplished in terms of their inflation fighting credibility, they would really choose the latter.
The hard landing.
Yeah. So and there was an interesting, one of our clients brought this up. They were saying that they were getting pushback that we're getting such a good boost in these non-cyclical components of the jobs market that maybe that's enough, right? Like, maybe cycles don't matter or something. Okay. And then it's the patterns here are really interesting. So it's the dark line is jobs growth without health and education, and you see that's pretty nasty looking, right? That's the one going straight down. And then if you want to say, hey, wait, as long as people are working, they're working. If they're working in schools and in healthcare, who cares? They're still getting a paycheck. It's all good, right? And what you see is, yes, there's, to some degree, that's been happening. There's this push here. It's flattened out a little bit. This is in the growth rates of the jobs. But what's fascinating is this kind of crossover here. We see that present itself, lo and behold, around recessions. Look at that. Here it is. Here it is. Here it is.
It's like their defensive careers, like a sector in the market, Lakshman.
Yeah.
People go to, people get sick, right? Their parents send their kids to school, and
all of us
people need to be trained. Yeah.
All of us are tuned into the markets, and we're watching this kind of stuff. And then your young adult child is saying, "I'm going to go here," and you're like, "Hey, doesn't look so good. You should work in education or healthcare for a spot and be busy."
Right.
and not bad advice. Less discretionary. Now, if you go to discretionary stuff, it's harder to make a bullish narrative, I think. But I'm happy to take questions and go.
Have you started to factor in AI and job replacement? How far away is that?
It not going to impact this cycle. Look, I love all of this potential. And by golly, if you look at the productivity data, it would scare you to death. So
Yeah.
the productivity growth. So the trends over time, and if you look at that, we need some AI driven productivity growth as a
That's what takes us out of
workforce.
the next downturn.
I
What do you
don't know if
think?
it's that fast. I think it takes a while. I mean, industrialization took a while, moving to service
Yeah.
sector took a while, moving to information services, we were
Yeah.
kind of there, moving to AI. That could take a while. That
Yeah.
I wouldn't hold your breath on that. I don't know.
Okay.
Maybe there's the other Moore every time, because I have Jeffrey Moore as my mentor, but there's another Jeffrey Moore who wrote about Into the Chasm, I think it was, and Moore's law. That Jeffrey Moore's law is that things, the
Right.
time it takes to do things gets cut in half, like the speed of a chip or something like that. So maybe it happens faster. Maybe I think it's 10 years and it's 5 years. I don't know, but it's not a matter of a year or two.
Can you imagine what kind of environment it's going to feel like next year, Lakshman, with
Well,
all the
by next year, and I'll tag off of this question here. By next year, we could have bottomed and gone into recovery. Our forward-looking indicators, I don't know. I can't predict the predictors.
okay.
We have a large array of leading indexes. One that we release publicly is a weekly leading index. The growth rate there has been improving a little bit of late. By its nature, it has some more exposure to market related indicators, and so that's a good part of that story. Conceptually, so people are understanding, we don't have models, we have leading indexes. The leading indexes are made up of indicators that have a very good theoretical reason for turning ahead of a turn in the target, in this case, growth. When we're looking for where we can get inputs, the key drivers of the economy, measures of those, to put into leading indicators, we can have market data, and that's more frequently available. You can have soft data, that's kind of like survey type stuff. And then you can have hard data, which would be more government created information and collected information. So in our forward-looking data, we try to have a nice balance between those three kind of sources. And what I'm sharing here is that some of the growth rates are firming, and it tends to be a bit more with the market related components. It's not very
okay. So
pervasive.
all right. Well, then let me ask you this: what would a 30% sell-off in the equity complex by the spring? What kind of effect is it going to have on your outlook should that occur?
Right. So we're not equity specific when I say market stuff, but
But it's
let's
about
just,
confidence, right?
yeah,
Especially the elite.
I'm gonna rephrase that and say risk off in the markets.
Okay.
And
Okay.
okay.
Fine.
And if it's more
Ambassador Lakshman.
and if it's risk off in the markets and those other pieces aren't coming up, then the growth rates are going to come back down. Now, we look at growth rates of our leading indicators, and then we look at the levels of our leading indicators. And the levels of our leading indicators collapsed in such a way that and this is not one index, this is a large array of indicators, not just for the US, globally even. they went down in such a hard way that it's recession. It's a hard landing. I would not be calling it straight if I said it was anything other. Okay. By dint of the level of those indexes not falling that much anymore, mathematically, the growth rates begin to become less and less negative
Okay.
and slightly positive. That's what's happened.
Okay.
And when I look inside, it's a lot of market stuff in there that's moving around. Although I'm not judgmental, I'm just saying, is it pervasive or not? It's not the other soft and the hard data so much. And so therefore, I'm like, all right. I respect the growth rates of the leading indicators going up. There's a bit of a risk on vibe, and you've seen that.
Yeah. Oh yeah.
Okay. But I also respect something else, which is that the bottoming in things like equities it's pretty stable cyclically. It tends to occur some 3 to 5 months ahead of the end of the recession. All right.
Got you.
So if the levels of our indicators have not risen in a convincing way, then hard to argue that there's an end to the cycle downturn, or a recession is what we're expecting, in sight. So we end up saying, yeah, we recognize and see the risk on vibe with the growth rates being less negative to slightly positive, but we're wary that there's a kind of a recessionary trapdoor out there, because it's hard to say all clear there's the recession, if there was one in the rearview mirror, or one right now, is behind us, is a done
Got
deal.
you.
So to the question, I think I lost it on the chat, but like, what's the forward look? I don't have a reacceleration. That's not in the cards here just yet.
Okay. Reacceleration of inflation.
In growth.
How about inflation?
Inflation's
And we'll wrap
interesting. So put everything on growth on hold. Let's just stick. Now we're only talking price inflation.
Yeah.
And so future inflation gauge had nailed the upturn back in 2020. It nailed the downturn, the cycle downturn afterwards. But what's interesting is that over a half a year ago, it went flat, the future inflation gauge. So it's come down, and then it flattens out, maybe a tiny bit up. I'm looking for a 3Ps move to say it's a new inflation cycle upturn. We don't have that.
Okay.
But it's gone like that. And that put us in this, whatever you call it now, everybody just says sticky, whatever. But that put us in that camp pretty early. And when we look at things like wage inflation, right?
Oh, yeah.
Pretty sticky. And if you pop your head up and you look for some anecdotal narrative, you immediately see strikes.
Right.
and if you talk to a manager, they say, yeah, I can't hire anybody. I can't get the plumber to come. Right.
Yeah.
So you're like, wait, I don't see wages coming down very fast here.
Yeah.
And that is consistent with this kind of fig going sideways. And that's, I think, consistent with the higher for longer, which circled all the way back to everybody's business plan, which is predicated on low rates, which don't exist.
Right. Wage price spiral. We haven't heard that in a long time, have we?
Yeah, I don't know if you're going to get the acceleration as much, but you're not going to get the come down. And that's even, I mean, I know that we know it in our
embedded
heads.
Yeah.
But we also know it in our heads. We're like, oh, inflation's coming down, right? So Wall Street tries to get bullish and says, look, inflation is clearly coming down. And okay. Yeah. But it doesn't mean the level of prices went down. And that's where we all live.
It's only the comparisons from prior year.
If you tell me my coffee costs $5 when I go down the street, I'm in New York. Okay. So it's horrible. Like freaking black coffee is $5. All right. So, and I'm just like, if that doesn't go to $5.25 or $5.50, okay, I'm excited it didn't go up, but I'm still annoyed that it's $5 because come on, it's just the hot water with some beans in it. It's not So that's
I
kind
know.
of like, I'm sitting there going, I can't believe a cup of coffee is $5.
Yeah. People are angry.
Yeah, yeah, and so
Look how it made your blood pressure go up.
it makes my blood pressure go. So I make my coffee at home. It's better coffee now. I'm having it at home. Yeah.
Lakshman, what a great conversation.
Nice to see
Everyone,
you.
yeah, in the chat, everyone's very appreciative, and
Oh,
we
thank you.
learn it. We learn every
Thank
time
you.
you're here, and
Yeah,
you're a great
I do.
watchman.
I do too. That's, and I'm horrible with I mean, puns, forgive me. But Dr. Moore liked puns, and he actually used to live next to Milton Friedman in Vermont, and they would talk about inflation, right? And
No
Friedman's like,
arguing.
it's all everywhere, it's money, it's always money. And Moore is like, look, I'm not making these models, but I'm doing indicators, right? And I will bring money into the leading indicators, and I do, right? It's very much there. But then he says, look, I'm a monetarist too, Milton, but I'm a monetarist with an eye. I watch. And so that's, I wouldn't even say, I mean, yeah, it's nice to predict an inflation cycle turn and a business cycle turn, but we're really monitoring the cycle indicators. And I'm trying to share that with you as objectively as I can.
And mission accomplished.
All right. Thank you.
Lakshman, thank you so much for being with us, and
All right.
have a great fall. We'll talk again in the winter.
Yeah,
See
let's
how
talk
things are
before the
playing.
new year.
Okay.
Would be great. So looking forward to continuing it, and have
All
a good
right.
fall.
Follow Lakshman at Business Cycle,
Business Cycle.
and go
You
to
got
his
it.
website and check it out.
Yeah.
And
Businesscycle.com. Thank you.
yes, edify yourself. All right, Lakshman, take care. Thank you
Bye-bye.
again. Bye-bye. So that's a wrap, everyone. You could join the team in 10 minutes on the Morning Edge. You're welcome. I'm glad you guys enjoyed it. Retweet it when you see it on Twitter. It's a great guest. And that's a wrap. Good hunting today, everyone. Don't just count your pips, count your blessings. See you tomorrow.
Hey traders, this is Blake Morrow with Forex Analytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.